All right. Hey, everyone. Welcome to the CLG podcast, where we break down the information asymmetry and all things blockchains, oracles, and smart contracts. So today, I have an episode with the one and only Crypto Oracle. It seems like we do an episode every 8 months, periodically, randomly, whenever things happen in the market. I talked with Daniel on the previous podcast about this weird market cycle that we've been in, but I think both of us have some thoughts about how this cycle is different than previous cycles and how there exists different types of games, the short term and the long term games within crypto, and then now you have airdrop farming all thrown on top of it, and it feels like a lot of the altcoins are sitting on the wayside and not getting nearly as much attention as Bitcoin and the meme coin. So it's a weird, I think it's a weird market cycle that we haven't seen before, and we'll be talking with Crypto Oracle to get some of his thoughts on this. So welcome. How you doing?
Yeah, good. Thanks for having me, Zach. Everybody knows who you are. Yeah, good to be here out of my hiatus. I know I haven't been as active in the past, so this is my, I guess, biannually check in with you. So, but yeah, it should be interesting. I feel like the market's in a weird, I don't know, spot, but not too weird when you look at all the dynamics at play.
Yeah, we can kick it off there. Like, how do you see this cycle compared to previous cycles? You've been in a few crypto cycles. Like, what stands out about this being different than previous years?
Well, for one, I mean, it definitely feels like the industry is more real than ever. Like it's kind of pretty generally accepted now, I think, way higher than it was in any past cycle that, blockchain technology, digital currency, is not just a fad. It's here, it's real. You have a lot, obviously tokenization from institutions is very real. Now we have ETFs. So I think in that regard, you don't feel like, you don't have these like questions like, is this all just, a fad, a scam? Is this all going away? Like I don't, even people who were skeptics 4 years ago, it doesn't, it feels like we crossed the chasm to some extent in terms of like acceptance that this is here. I think, you know, like you kind of alluded to and we talked about before, you kind of have two markets going on and then kind of ignored part of the market. So obviously with the ETFs with Bitcoin, Bitcoin is like that is like the most real like product thing in the space is Bitcoin. And so with ETFs, you just have a lot of more institutional money flowing in and people wanting to hold it on their, wanting to hold some of their, retirement fund or whatever in Bitcoin. Like that's just 1-2%, but you add that up over lots of people and lots of institutions, that's a lot of money. So it's like Bitcoin is kind of front and center. And then on the other hand, you have this totally other game going on, which is really the crypto casino, which we can get a little bit more into the dynamics of that. But so you kind of have this, you're either in Bitcoin or maybe you're in kind of Ethereum, or you're in this kind of crypto casino land. And then you have like this middle ground where you have these kind of real projects that, some you call them altcoins, but it's really much more you got to be more distinct, like projects that are actually trying to build something in the space, like the ChainLinks, like the Aves, like other layer one blockchains and L2s. And they're kind of like ignored. I don't know, when I think about it, it's like on the Bitcoin side, it's like mostly normal people or institutions that want to take less risk, but want some exposure to crypto because they've seen the gains over time, and it's a kind of a different asset class that they want some exposure to. But again, they probably don't put, it's probably a low allocation of their assets, 1-2%. So it's kind of like a less risky, higher upside play for a lot of people. And also, obviously, you can invest directly through your retirement fund or whatever. So, and then you have the other one. It's like, I want to try to just make it big or not make it at all. It's like we've said before, it's a lottery. I've watched the news and seeing all these people who go become millionaires overnight, over a short period of time from crypto. And you sent me something, and this is something I've thought about myself, is like it's one of the only things out there these days where you can make a large leap in your life economically through crypto. Like there's not your stocks, okay, you can make money, but it's over a much longer period. The gains are much more or lower. Whereas crypto, you could potentially 10, 100 extra money in a year. And for a lot of people, that's very enticing. And if it goes to zero, it goes to zero. And so I think it's just like people want to play this highly speculative game. And that's why you have meme coins, not just memes, but also projects that are like not really real. They just are they're piggybacking on some type of hype, like AI coins. Like, okay, we all know that almost all those coins are probably pretty dog shit. I mean, I'm sure there are some real builders out there, but for the most part, it's like, hey, let's put AI in the title, and then it just gets this hype meme-like cycle, even though it's going nowhere.
I feel like there's definitely those two different categories. I feel like I would break it down like there's Bitcoin, which is really in its own category altogether, especially with the ETFs. That's something that institutions and normies look at and generally understand. It's digital gold. It's been around for so long. It's just in its own category. Then you have like the other side of the spectrum you mentioned that are just meme coins. They've accepted that they have no utility. It's actually an advantage. When meme coins try to add utility, it does it like the vibes come off, and then like nobody's interested anymore because they're trying to be real. Like people buy the meme coins specifically because they're lottery tickets, and it just becomes a narrative game of musical chairs of how can we promote this token as much as possible and then exit before everyone else. Like that's just the game that's being played. But I feel like there's these other categories of like kind of alluded to this, but like there's the DeFi OGs like the Aave and the Chainlink, where the end state of those protocols is enabling like actual on-chain finance and on-chain economy. And a lot of that will come through institutions and tokenized assets, but that's a very long-term game, and we're still in the very early innings, and it doesn't help that the regulatory climate in the US is a little bit hostile towards that whole thesis. So like I think there's less attention and less excitement around that because people know it's going to take a long time. But I think there's a whole other new selection of coins that I would bucket basically under VC coins, where these are newer protocols with their own tokens, but the tokenomics are very different than what tokens used to be. Because tokens back in 2017 were public ICOs. They would sell a large portion of the supply to investors, retail investors, and then most of it would be distributed in trading. Some portion would be locked up via the team and VCs, but most of it's in the community. You can't really do that model anymore. That ICO model was effectively shut down. And so now you can't do public ICO token sales. So what we see is that the tokenomics of tokens have concentrated to the point where teams will do airdrops of their token and give them away, but they'll typically give away about 5% of their tokens, and then the team and the VCs will hold about 95%. And then you get this weird dynamic where airdrop farmers inflate up the protocol metrics, which lead to a high valuation, which means you have a very low float, a low circulating supply, but a very, very high fully diluted value that then gets unlocked through VCs and the team, and they end up realizing that value. So like if you're buying tokens when they first launch, there's not a lot of upside. Like to be honest, like a lot of the tokens bleed versus in ICO days, you could still lose everything, but like the ability to actually make 100x was realistic. If you buy a new airdrop token, that's not really super realistic. So I think part of the reason people gravitate towards meme coins is that like they're almost like the ICO model. Like there's no utility, even though a lot of ICOs didn't, but like you actually have some level of upside versus the newer airdrop VC coins. There's just you're providing liquidity to the VCs who will unlock and then use you as liquidity. I think that dynamic is getting a little bit more realized for people, which is unfortunate, but it's the game has changed, I think.
Yeah, I kind of view that as an extension of meme coins, even though people like conflating it. Like they are trying to apply the highly speculative meme coin type games of just like speculate, speculate, speculate to these coins that are like trying to be real projects, but they're also trying to play that meme coin like game of get the price high and whatever. So like they're applying it to that, but then that game kind of this always happens at the beginning of a coin's life cycle, is you get this kind of like speculative, highly speculative game going on, and then it happens. You know, they launch, or they become, you know, they launch, they
They
unlock
become real.
tokens. Yeah, they become real, and then that game ends, and then they go into this category we're talking about with DeFi projects, assuming they're really trying to do something. Some of them kind of like, you know, they try for a little bit, you know, or maybe they don't, and then they kind of slow rug where they just try to like they do stuff on their GitHub and stuff, but I don't think they're trying too hard to actually be real. They just have a lot of tokens left to unlock, and they need to discontinue activities, so they continue to unlock them, and slowly it fades more and more over time. But to the point before about the meme coin, it's a really interesting phenomenon, because it's like I think of it like I don't even think of it like, I know I said speculation. It's a game. It's like a game. That's a player versus player game in a way, but you have to work together as well, which I find kind of interesting. It's like you all agree that this you try to get people to buy this particular token. So you have to come together initially to get people to buy a token. And you all agree that if we all buy it, it's going to go up. And without us all buying and getting more people to buy, it doesn't go up. But then at some point, we got to screw each other over and get out. And if you don't get out quick enough, you lose. But like if we all sell too early, it doesn't go up very high. So it's like this game of musical chairs that we're playing. And at some point, when someone starts to blink, we all get out. But it's crazy how some of these coins like Shiba can go up way beyond what is rational, like the amount of irrationality. I do think the amount of irrationality decreases over time, because people jump out sooner, and then, okay, you jumped out sooner, I'm going to jump out a little sooner next time, and it like decreases. Although things do cease to surprise me every year where it gets a little crazier, but it's uh it's an interesting phenomenon. And like I think one of the problems is that I feel like it creates this belief like that everybody is making crazy gains in the market, because like one or two meme coins or an AI coin goes up a lot, and it seems like on crypto Twitter that, oh man, everybody's making 10 100x, and that's just totally not the case in my opinion. Of course, I think there are some few people who get lucky, because you got to think about it. You got to be lucky enough to get in early to make, I mean, depending on what your idea of good money is, like if you want to make a lot of money, you got to put a decent amount of money in, which is a lot of risk, because it's hard to say whether that one meme coin is the one in two, three, one in 500 coin that actually goes up a lot, because most of them don't. So you try to take on a lot of risk. So even these like traders who maybe are bigger whale accounts, like I don't think they're putting in that much money because it's just so much risk. And so I think this perception that everybody's making when only like some people are making, and how long do you even stay in the coin? Like how are people really staying in from the beginning all the way to the end to get that full 10, 100x? Like I bet there's very few people who actually do that. So like it's like this perception that everybody's just hitting on all these coins. Like I don't think that's really the case at all. Like I think it's very selective, and you might hit one out of, all you need is one, but you might hit one out of 100, but then if you lose a bunch in those other ones, how much does that cancel out what you actually made? It's hard to say.
There's definitely a very heavy survivorship bias. Like you will absolutely hear when somebody puts $100 into a coin and becomes a millionaire. You're not going to hear about the orders of magnitude more situations where people put money in a coin and lost it all, because there's no incentive to talk about that situation. So you don't hear about it. Like same with the meme coins. You hear the few coins that did very well. You don't hear about the tens of thousands that just rugged day one and everyone got out of the game very quickly. So it's like people have this perception that, oh, if you just get into meme coins, like you'll do fantastic. But then like when you start playing that game, it actually becomes clear that it's a very difficult game to play. But then people will start making comparisons between, why am I holding these other coins that are trying to do something real and have a long-term vision when I could just hop on the meme coin train and instantly make a bunch of money and exit? Like that's kind of the fantasy people have, and then they get this sense of opportunity cost. And I've seen this across basically almost every DeFi coin, altcoin, however you want to categorize it, every one of those communities where their token is basically performing exactly on par with the rest of the altcoin market, but everyone just has this deep sense of opportunity cost. So everyone's super depressed and feels like they're missing out on these massive gains that you mentioned that realistically is not a lot of people in the first place. And the people who make those gains take on just an insane amount of risk. And there's probably 1,000 times that amount of people who just lost everything playing this game. So I feel like that's created a weird energy where people who hung on to Bitcoin and just kind of ignored the whole cycle, they're doing fine. Like the meme coin degeneracy casino had its own game. Everyone understands that game, and then everyone else is sitting on the game, the sidelines, and all the other DeFi coins not seeing a whole lot of action and seeing everything else exploding, and they feel like they're missing out on this big party that they weren't invited to or something. Which I just think it's an unfair comparison.
Let me ask you a question. What do you say to someone? You say your normie friend comes up to you, is like, "Hey, what do I invest in?" And you know that they want this lottery ticket type thing, but you know they're not going to invest the amount of time because like you know that if you really want to do, if you have a chance of doing well, you got to spend a lot of time and you got to find where everybody hangs out. You got to find the forums and Discord groups and the telegrams. And you got to follow it really close. And you know that they're not going to invest that amount of time, but they want that kind of gain. Sometimes I'm like, I don't even know what to say. Like, I'm curious how you approach that because I'm sure you get that question.
I mean, on the one end, I don't like telling people to buy crypto because it's a lose-lose situation, but like particularly with friends where like if it does well, like they're a genius. If it does bad, like it's your fault. So it's a lose-lose. Usually I tell them to focus on the majors, the Bitcoin, ETH link, and then just put that into a safe and forget about it for 10 years. And if they're interested in the meme coin casino game, I legitimately can't help them because I don't have any edge. I don't have any alpha. I don't have any good strategies for that. And if anything you say doesn't work, then it's your fault that it didn't work. It's your fault they lost money. It's like there's no situation where you're actually helping them in that situation. So beyond that, if they're really dedicated, I'll tell them get some soul, go on Solana, and then just like figure it out. Like just start engaging with Dex Screener. But like I don't even want to recommend people engage in that game because it's like leading people to the slaughterhouse. I morally wouldn't feel very good about myself for doing that.
Yeah, I just be honest. I just try to tell them like, look, that is a part of the game, but like you gotta first off, you gotta be okay losing it all, and second of all, you gotta. It's like a full-time job. Like if you really like the things that you read about that you think are happening, like it's very few, and these people are like, this is all they do, and I know they're not willing to spend that amount of time. So it's like if you want to like a less risk, maybe join the majors and forget about it. But you're not gonna. The chances of you making 100x are not, or if you do, it's going to be over a very long period of time. And so, yeah, it's I hate that. I try to avoid that. I try to just like, oh, I don't know. I hate that question. Just kind of brush it off.
I would say it's probably better for most people to focus on airdrop farming rather than meme coin casinos because like the upside's less, but the downside is like unless a protocol gets hacked or something, there's not a whole lot of downside to airdrop farming, and that gets them to actually use the protocols and start engaging with more than just swapping something on Uniswap or Jupiter or Pumped Out Fun or something, gets them using the protocols, and then they get some skin in the game. That's usually, I think, a better bet for people. But that's all. Airdrops like a whole different type of game where I like protocols are effectively just paying for usage. Like everyone knows that protocols are just paying for usage, but everyone kind of plays it up of like, oh, they're building a community. Look at this adoption. Like they're growing so much, but everyone's just like wants the token and then they'll sell the token and they move on to the next project. It's like that's like not the meme coin game, but it's like a whole parallel game going on where everyone kind of pretends that it's just usage and adoption and growth and organic, and then in reality, it's just financial incentives at the end of the day. And then you gets into a cycle of like all the token, like the users just want the maximum amount of tokens, and they don't want the teams to have anything. And then the teams basically see as an opportunity to milk revenue and fees and adoption metrics that then they can promote to VCs and raise capital based off the backs of airdrop farmers, and then maybe or maybe not pay out the airdrop farmers at the end. So like that's like a game between teams and VCs and users. Like it's also PvP, but at the same time, a little bit of collaboration going on there. But I don't know. I'm curious your thoughts on like the whole airdrop game. Like, is that a cycle, a mega trend that's going to keep continuing forever in our cycle? Because I don't see any other way tokens can really be distributed to people in the current state.
Well, it's kind of like a large purpose of tokens is to use it to incentivize usage in the beginning. I do wonder how beneficial it is long term. Like, how many people do they actually retain? Because, like, if you look at, you know, actual daily usage or, recurring usage, it's not very high, even amongst the most widely used. Maybe the only one are like dexes, I think, because you're just swapping for speculation. Um, so it's you kind of have to like you gotta like get your metrics up, because if you're going to like what is the end goal of a lot of these DeFi protocols? Like, is it to like become their own app, or is it to maybe that's not the right phrase, like you're becoming like a competitor to traditional services, like say Aave is a competitor to traditional lenders, or is it to get the traditional lenders to build their own markets on your protocol? Um, I bet different protocols have different goals. Like, I don't know how, besides a DEX, I think it's going to be very hard for DeFi protocols to compete with traditional systems, no matter how much I might want them to or not. Uh, it's just how many people are looking for those or want those services outside of traditional, like maybe more time, but I feel like a lot of them, they they want big players to bring money and to build markets on top of them. And if that's the case, you have to like become the market leader, at least in this niche category, to even get recognized. Without, because if you don't have that, you don't get recognized, and then it's like, well, why would they build on you? So it's like, it's almost like, how can we like be the most recognizable part long enough so then we get recognized and bigger players start to build on top of us? Or the other route is you start to compete with them, but one, you're facing a heavily uphill battle from regulators. Like, they clearly don't want this decentralized finance system to exist. So you have that hurdle, which is unfortunate, but is very real. And then you need their capital, kind of like, is retail big enough, or is the demand high enough to create a market, say on lending or derivatives, that can compete with the trillions of dollars that exist in these other systems, where the high net worth individuals that have most of the money. I mean, if you look at wealth dispersion, it's very much concentrated at the top. So how do you compete with that? I don't know if realistically, I think it's going to be very, very difficult to compete with them. Maybe on a very long time frame, perhaps. Like, I don't even think we're close to that. Like, you need this industry to become so established that it's like more generally accepted to just go get a loan on something like that. So yeah, on the next 10 years, I don't see that them being able to compete very well, but maybe on a longer time frame.
Yeah, it seems like there's definitely going to be a splintering just between the more permissioned ecosystem of DeFi applications that lean into full KYC AML protections, permission assets, and then the underground, not, I would say, gray market type area, like basically darknet markets, except not selling drugs, selling tokens. And like that's something that won't go away, but how big is the market, those types of activity? Like, it exists. It's honestly what most of crypto is today, is kind of this gray area casino for a lot of people. But yeah, it seems like I've always just seen DeFi as purely a case study for what these applications can look like when they are in an institutional setting for people. But every geographic region is going to have their own implementation. They're going to want their own ledger, going to want their own deployments, and it's likely going to want to be managed by the banks themselves, which is kind of not necessarily the full crypto idealism, which frames everything that's kind of being done in crypto now in a weird light, where like if you're an institution and you're looking down in crypto and you see people gambling on meme coins and farming airdrop tokens and playing PvP against each other. Like, why would you want to be a part of that system? Like, you want all the benefits. You want the tokenized assets. You want the benefits of the distributed ledgers and the actual dApps, but that's like maybe 10% of what crypto is, maybe more like 1% of what crypto is. The other 99% is just the retail casino game. So I feel like there eventually will have to be a splintering between the two inevitably. And I feel like it'll be a little bit painful for a lot of people when they realize that a lot of these applications are not going to be the same applications used when institutions step in. I think a lot of the infrastructure will remain because a lot of the infrastructure like Chainlink works just as well in a public environment as it does in a private environment. But a lot of the top level applications, like you either have to go full retail or go full institution. It seems like it's not viable to try and do both at the same time at this stage because there's just two completely different market requirements from those two audiences. I don't see how they commingle them for at least the next few years. I'm curious if do you think they'll ever be like are those two audiences ever going to commingle on the same like ledgers, or is it purely always going to be fragmented worlds that will just have to be connected?
I mean, I pretty much agree with what you're saying is that I think, like, I'm just being completely honest. That doesn't mean that this is what I would want, but this is what I think will happen, is you'll just see a basically consolidation to the institutional side. Like if you want to be like, be widely adopted, you'll have to go this kind of regulated institutional route. Like they should fight as much as they can to prevent it from going full TradFi, where you don't get the benefit. You need to retain, best you can do, I think, is try to retain as many of the benefits as you can, but accepting you're not going to be some full trustless system. Like it's not going to happen anytime soon. I've said this before, there's not enough political will, there's not enough people that are pissed off enough that were willing to fight for it. So you need to try to retain as much as you can. And like you said, there'll be like this gray black market area that exists. But again, that's going to be much smaller because most people won't want to take on the legal risk to do it. And so it just kind of is what it is. I am curious, like, what do you think is like the next like wave like for crypto? Like I have some thoughts, like just my own personal thoughts is one, I think stable coin payments are going to be very, like, I think it's one of the most important things for the next wave of adoption is that people start using stable coins as a form of regular everyday payment. Like I go to the store, I buy something and I just scan my QR code for USDC or whatever, and I just pay. Like I think that is like very realistic to me. I think this is kind of the same thing of where like CBDCs move, like where there's just going to be digital currencies that you have on your phone, just like all around the world. You have payment apps like M-Peso and Apple Pay and all these things that you're just going to have digital currencies linked in, whether those are stable coins like USDC. I think it's going to be very hard for, I'd be cool to just get like a MakerDAO or some of these other ones in there, but it's going to be definitely going to get like the USDCs, probably the CBDCs, like probably going to have banks have their own types of coins in there as well, or maybe you just your bank deposit cash is a my deposit is a digital currency in my account. But I think that's going to be kind of the next big thing. And then also, I mean, this is the whole industry. It's kind of funny that tokenization is like come full circle. It just seems like the new format for finance is just going to be tokens. Like every asset is a token, and these tokens exist on ledgers. There's going to be a lot of different ledgers. You're going to have, like CCIP that's connecting these different ledgers, allowing them to settle much more efficiently and cheaply, through things like DVP. And that's just like the way the financial system is going to work. And I think like that kind of will be the real mainstream adoption of our industry. It's not like I'm going to be using all these different tokens and all these different applications on blockchain stuff. Like, that might be the wave after that as you get more like crypto native apps like gaming and some of these other um insurance, like I don't know. But I think, yeah, like I said, tokenization becoming embedded into capital markets, and then stable coin payments just in the retail level, I think are like kind of the next big waves in my opinion.
Yeah, I think I'm broadly in line. With stable coins, it's funny. Like it's the besides the casino itself, it's the most dominant use case of blockchains. There's 100 billion, 160 billion dollars of tokenized dollars, stable coins on chain. Like they've proven their viability and they've just very clear utility. It's just a superior representation of dollars, and the demand is pretty obvious. It does more settlement volume than PayPal by far, and almost as much as Visa does at this point in terms of just transaction volume. And I feel like going forward, it's weird to me that the US is so aggressive against stablecoins. I think it's just a symptom of them being aggressive against crypto in general. And that's a bit of cutting off their nose to spite their face because stablecoins are one of the largest purchasers of US treasuries globally. Like they hold more government debt than most countries. I think the number was like all stablecoins together would be like the 16th largest country of treasury holdings, which the US needs people to be buying its debt over time as other foreign nations sell the US debt. So it's actually stablecoins are actually really, really important and useful for the U.S. government, which I find it weird that they're pushing back against it so much. So if the U.S. actually embraces stablecoins with clear like regulation, basically gives the green light, then I think we'll just see an absolute explosion in like stablecoin supply, and we'll see the more retail type operations of Stripe, PayPal, like actual commerce through stablecoins itself, whether it's on Solana or some other blockchain or higher level layer two network. It seems pretty obvious. But if the US continues to crack down on stablecoins, like 99% of stablecoins, probably more, are US dollar backed and denominated. If the US keeps cracking down, like other regions are not going to be ignoring stablecoins. Like we'll see Hong Kong dollar stablecoins, we'll see Singaporean dollar stablecoins, we'll see Euro stablecoins. Like we'll see lots of other fiat currencies be stablecoins because they want the same influence that the dollar has, and stablecoins are like a medium to get fiat currency into more people's hands, which the government themselves want. So if the US keeps cracking down, then we'll see like a huge explosion in diversity of stablecoins, which may not really be a great thing for consumers. There's just fragmentation, but and being in the US, I'm biased against that world. But to me, I don't see how regulators can keep ignoring stablecoins. It's not something you could shut down, really. It's like there's so much clear market demand at this point.
Right. And I guess when I think about it now, it, it's would be very like it now, like the US obviously is like the world reserve currency, and it's easiest to use and accepted. But in a more digital on-chain sense, like it's probably much easier for me to use. Like say I want to have Singaporean dollars and it's a pretty stable, say, currency. I don't know much about it, but I assume it's fairly stable considering it's Singapore. It'd be pretty easy, I think, from a technical perspective for me to pay at a US retailer in a Singaporean uh coin. And maybe that's swapped or whatever. Like I would think it'd be easier to do than to do it through a kind of more traditional method. So you could see like people like if I'm like I'm thinking in the past we've really seen US citizens like hold other currencies, but you could see a world where people like your bank account is not just denominated in your local currency completely. You might have more exposure to other currencies because they're simply, well, you can hedge your risk. They're just a little bit they're easier to hold than they would be. Like, how would I hold Singaporean dollars now? Like, I don't have a bank account in Singapore. Like, how would I do that? But if I just need a digital wallet, it's kind of easy. Like I could get exposure to, that's why people in Venezuela can hold US dollars through stable coins instead of holding the local currency or whatever. That wasn't really possible, I don't think, before. I mean, not in a realistic sense. Wasn't really possible for, especially for individuals, unless you just want to keep a bunch of money under your mattress. But then you actually have to go to the country to get it, or you have to go to, swap it at an exchange. So that's kind of an interesting thing that I didn't really think about before. But it could be a lot easier for you to just denominate your wealth in currencies that you find are most stable and attractive, and those could be more widely accepted at merchants, not just. I mean, you could see governments try to demand that only their currency is accepted, but I guess it'd be kind of. I mean, you can pay. I can pay. You can pay with your credit card in U.S. dollars and places all around the world. So I guess I don't know. It's kind of an interesting phenomenon I didn't really think about. But so if the U.S. kind of, if it was hard to use or they were against it, it could actually see people diversify their wealth out of U.S. dollars just because it's easier to do now.
And that may unfortunately lead to a case where if the US shuns stablecoins and these other fiat denominated stablecoins become more popular and it's easy to transition from dollars into those other stablecoins, that may be like a reason they want to crack down even further on it because they don't want capital fleeing. But I do think in general, like in crypto, it seems like what you're talking about, I would call it like capital abstraction, is almost like a broader trend that's happening where the end state is you just hold the assets that you want to hold, and then you pay people in those assets and they receive what they want to hold on the network that they want to hold it on. And all that's abstracted away. It's like everybody having to, if you're onboarded to Ethereum or the L2s, you need to hold ETH. I think the end stage, you hold whatever you want to hold, and you pay the network costs and whatever you want to pay it in. And in the background, it gets converted and flows through the financial plumbing of blockchains. But it seems like that's the end state, and I think we're seeing the beginnings of that within crypto itself, with like account abstraction and chain abstraction and like just atomic swaps and atomic settlements. Like I think it's going to very easily translate into traditional finance, and it's a little ironic that like one of the biggest value props here is just reducing friction, uh, like reducing back-end settlement friction, and yet the actual like user interface level interactions with crypto is full of friction still. It's like I think people think of crypto, they think of like this weird janky software stuff that nobody understands how to use. You got to write down 12 words and forget those words and you lose all your money forever. But in reality, the backend's actually way less friction because there's not just this fragmentation of systems. If you want to pay somebody and you could pay somebody and anyone in the world with any currency that you want, and it doesn't have to flow through specific institutions and go through correspondent banking and flow through all these middlemen where each one takes the cut. Like I think that's like the fundamental value prop, and I think it like when it comes to why institutions would want this, it just comes down to better margins and more revenue for them. If they can offer custody services and these to facilitate the swaps and they can make revenue off of that, that's like probably going to be the reason why they would adopt stable coins. It's just more revenue opportunity. Like they're not going to adopt stable coins because they just love stable coins and they love crypto so much. They'll do it because it's economically profitable for them to do it. And if they can reduce their own margins and take a lower fee, but still generate more revenue in aggregate because they don't have to pay all the middlemen costs, that is just the natural end state. And these institutions, like there's a lot of regulatory blockers. It gets too partisan and too political, but like Larry Fink, if he wants tokenized assets, like he's going to apply pressure on regulators, and he's much more likely to get things actually done on Capitol Hill versus the three devs in a basement creating a sketchy DEX perp exchange. It's not going to have any influence over how crypto is regulated. So, like, I think it's really, I don't think that case has necessarily been made clear to every institution. I think they just see like, oh, I could tokenize assets and get more customers, but like actually replacing a lot of the archaic processes probably just going to take a while. I think that's the main thing. But like that's I think the ultimate value prop of crypto for institutions is just reducing that friction.
Well, I definitely think it'll make things more efficient for them. Yeah, I do agree that I don't think banks are going away. I think the reality is most people want them custody. Like if people whoever creates an app that they take custody and they take kind of abstract away the responsibility, maybe give you some type of insurance on your money, make it easier for you to use, then also kind of LPs. I guess the bank would be kind of like an LP, or they would help facilitate these swaps for a very small fee. I mean, I think that's probably how most people are going to interact with crypto, and then banks will compete on margin by offering the lowest rates for facilitating that, whether that's for both for swaps and for the amount you're paying for custody. So I imagine most people will just, I always imagine people just having a bit of a banking app or, some type of little payment app that they just use that has all their crypto and stuff. And I know they already exist, but people want to abstract away like their private key and a lot of those things. They just want to like press a button and that's it. I mean, that's kind of where I see it going. It's not like the trustless, everybody owns their own currency. Sounds nice, but it's just not. I mean, I don't even, I wouldn't even trust most of my friends like with that. Like that us don't, like every time they move money, they gotta call me and they're just scared out of their mind, even though I've shown them how to do it like 10 times.
Yeah, speaking about RWAs, I think one thing people don't understand is like what role Chainlink plays in the whole tokenized asset thesis. Because I think when people talk about RWAs, they think either like the settlement layer, like the Ledger, Ethereum, or they think about the token issuer, or like Securitize or the asset manager like BlackRock, or they think of like just the those main players. But I don't think a lot of people think about the other layers of the infrastructure that sits between the two. Like I've read a lot of like the RDBA tweet threads, and it's gets into the meme coins of, oh, this is a sub $5 million coin. They're totally gonna do RDBAs and ride that narrative, which it's just the same meme coin game. But I'm curious, like if you had to distill it down like very simply in terms of like how things are moving with tokenized assets and onboarding capital markets, like what role does Chainlink actually play in this?
So if you want, Sergey's talked about this a bunch, but I mean, it's really comes down to, I see it as two things. One, obviously everybody knows CCIP is you need to move assets across chains. Like people are going to issue assets on their preferred chain, but there are users across many different chains, whether that's public chains, private chains. Like you need something that facilitates the movement of these assets across chains for users that buyers and sellers that exist on different chains. And you need to do that in like basically a trustless manner, or they call it DVP, where the asset is delivered to the user and the payment is delivered at the same exact simultaneously, or it doesn't happen at all. And that prevents counterparty risk. So it's basically like CCIP like takes the assets in escrow, verifies the signatures on both of these or whatever, and then swaps them. And then so then you have this kind of, and you don't need an intermediary. It's kind of like facilitating these trustless swaps across. And as tokenized assets, as more assets become tokenized, like anything of value, and payments become tokenized, then they're on the same infrastructure, like on-chain infrastructure, and you can facilitate that. So that's obviously one, is moving assets across different chains. The other one is simply providing the data that these assets need in order to facilitate transactions, whether that's I need to do an identity check, I need to price the swap, and I need to know the price of the assets, I need to know the net asset value of a fund if I'm buying a tokenized share. Like there are a lot of data type or reserve. I need to check that this asset is backed by the reserves. It's because you get all these assets that are representations of off-chain assets. I need some type of verification that those assets exist. Maybe I want another condition. Maybe I want an auditor to attest to their quality. You need a lot of, in the real world, you need a lot, there are data that people need about the asset before the transaction can even happen. So obviously you have Chainlink that can provide that data, can also provide data back into existing systems, giving them, say, update status on a transaction, things like that. Also, you need like, if I'm doing an asset on one or two, the assets exist across different chains. Sometimes you might need those chains to talk to each other to facilitate swaps. And so there's just a lot of data, whether that's cross-chain between existing systems and blockchains. So data, moving data, you get providing data to allow transactions to happen, and then allowing those assets to move across chains. And then that can exist across, whether the asset is wherever it originated or where it exists now, that can happen anywhere at any time. So that would what I would still get down to.
Yeah, the way I kind of think about it is like one of the innovations of blockchains is that it's both it's this layer where both the assets live and who owns those assets, and it's the layer where all the information about the assets exist, who's allowed to own it, what's the state of the asset, like the whole all the interactions around the asset itself. And so like when you tokenize assets, you're still going to have the ownership on chain, but all that metadata is not going to inherently exist on chain if it's about an off-chain asset or it's about an off-chain process or an off-chain business, whether it's revenue data or nav data or just does the asset actually exist if it's a physical asset. So it's really just the same exact Oracle problem that Chainlink's been doing for like a decade at this point, just solving in the context of tokenized assets. And I think like the interesting one is like the cross-chain component where like things started in crypto where like people had this belief that we'll have, this one blockchain, it'll be the smart contract blockchain. Everyone's going to come to this blockchain. They're going to adopt this one. And people basically figured out that doesn't scale at all. With Ethereum, that basically broke down, and then now they've just embraced the multi-chain. Lots of L2s, they'll scale out that way. There's still some chains trying to scale their individual chain themselves, but I think everyone's pretty much accepted the thesis of like one chain just dominating everything is not going to be realistic. And I feel like the same process happened or is still actually happening in TradFi where there's like this competing thesis of like the multi-chain world. Every geographic region, every bank is going to want their own blockchain because they all have different requirements, and then they'll need interoperability between that. That's effectively the Swift thesis and why they're working with Chainlink to facilitate that. And then you have like the unified ledger thesis where like there's going to be one blockchain that's going to be stamped by the government. Everyone's going to come to that blockchain, and that'll be the dominant blockchain. And that's kind of the BIS pitched approach of tokenized asset settlement. But I think they're going to run into the same exact problems that DeFi has, which is one, that doesn't scale, it never scales, and two, coordination. Like, how are you going to get everyone in the world to agree to use one ledger? When has that ever worked? Like, the internet's different because it's just passing messages, but everyone uses different servers and websites. But getting everyone to agree about one single ledger, like, why is China and Russia going to want to use the ledger that's stamped and approved by the US and the West? They're probably not. They're probably going to want their own implementation, but there's still going to be entities that need to trade between those different ledgers. So like it seems like all the theses that were proving to be the case in DeFi, that you need oracles, you need cross-chain, there'll be multiple chains, are still kind of being realized in the TradFi sphere as they start to scale out those interactions. So the same problems Chainlink solves in DeFi are the same exact problems it's going to solve in TradFi. And I don't think that dynamic's clicked. I think people just see institutions, they see money, and don't really understand the role Chainlink plays. But yeah, it's all these dynamics.
I've seen, I forget who said it. I don't know if it's someone from Coinbase or I don't know. But people say a unified ledger is literally a national security risk for many countries. Like, because I'm sure the unified ledger is not going to be some trustless system. Like, it's going to have admin privileges to whoever. And so to get everyone to agree on one ledger about who owns what assets, which is a very, very important thing. Yeah, I don't see that happening. I also think you assume the multi-chain world. I think now I think no, I don't think this will happen right away, but I do think it will kind of be a winner take all type thing in terms of the infrastructure in between the chains, because I mean we see that with the internet, but the reason, and I'm not just saying that because obviously Chainlink does CCIP, but like you need a set of common standards, like common security standards across transactions, we're out, because if you have all these different types of standards, it's a lot of, oh, I like this standard, you don't like this standard, and then, okay, well, we don't trade. And then it's like, it becomes all mumble jumbled. You have a wider attack surface. I think people will just coalesce around one common standard. Now, you might have levers that you can tweak for your transaction, but it's like this consensus mechanism is the best, or this security infrastructure is the best for, the standardized across the industry. So we're all kind of on, it just makes things more efficient. So I do think it'll be kind of a winner take all for the infrastructure in between the chains, whereas the chains there'll be a ton of them. And then you have different levers that you can tweak in that common infrastructure.
Yeah, and in terms of interoperability, like interoperability isn't just chains to chains connecting the two, but it's also chains to backend systems. And pretty much every crypto interoperability protocol is like so honed in on DeFi and public chains of how do we support as many chains and as many tokens as possible. And so like a lot of them are very, very long tail tokens and very, very long tail chains that seem to work out because you have this chain rotation cycle and this whole speculative aspect of people rotating capital, and they need bridges to do that. So like almost all the bridge interoperability usage today is either airdrop farmers, and when they leave, you see the layer zero effect of usage dropping by 90%, or it's just people rotating capital for speculation or airdrop farming and moving capital between chains. I don't see any other protocol like CCIP that's trying to adopt the existing messaging standards that are already used in the TradFi system that they can then use to not only facilitate interoperability between chains moving tokens, but also just communicating and talking to blockchains in the first place. Like those are actually two very different problems that I think is interesting that CCIP solves both. Like I don't really see another infrastructure that tries to tackle both of those problems and actually is working with those who want that solution.
One thing I wanted to point out too that you brought up, I think people just need to put into perspective that the cross-chain market right now is not as large as I think kind of the perception. Like, how many times do people need to move? First off, how many retail users actively move capital around the cross-chain today? Like, it's not that big. And like you said, a lot of it's airdrop farming, but it's so one, the markets for the kind of DeFi native airdrop farm is not that big. And like you said, a lot of it's inflated just because people are farming. But like, so, what having a ton of transactions today, first off, it's a small market. And second off, it's just not very useful yet. It's not a big market yet. And I think really the bigger picture is the tokenized asset market is when financial system actually begins to move assets across chains because bank A lists this asset on their chain, somebody on some other chain wants to buy it. That's like going to completely dwarf the retail market. And like same with like dApps. There's not a lot of dApps that are sending messages cross chain on some type of consistent basis. So that's why I don't think you're going to see massive transaction volumes on cross chain just yet. A lot of it, again, like you said, is airdrop farming. Once that dries up, it's not as high as you think. It will grow over time, but I think the majority of it will come from when tokenized assets start to move around. As I don't know. I mean, how often do you think dApps will move messages cross chain and they're more end state?
I mean, right now it's I would say probably 99% is just retail moving money. Raw actual messaging, like communications between smart contracts, cross-chain apps don't really exist at this stage. I do feel like there's like three approaches to bridges. There's like let's just optimize for retail, moving money as quickly as possible, which is what we see with a lot of intense-based bridging, which works well for retail, even if it has the same centralizing effects as MEV, where you really just have market makers filling orders and extracting value through there. But that's one game you can facilitate in the short term with just crypto tokens. You have like let's just get the airdrop farmers, let's just inflate our metrics as much as possible, make ourselves look like a standard, and then once you eventually launch the token, then people realize it was mostly just airdrop farmers all along. And then like the third is actually building for like the end state of yeah, you need to facilitate airdrop or you need to facilitate retail users in the short term just to get some level of usage on that infrastructure, but really it's not what you're actually optimizing for. And so I think like even just comparing CCIP to other bridges, I think doesn't really accept that there's a difference in scope and there's a completely different approach being taken. A lot of these other bridges are never going to be used on private chains and are never going to actually touch the institutions who will be moving orders of magnitude more volume than every other bridge that exists today combined. And so it's really just almost not exactly the meme coin versus like legitimate project game in crypto, but it's almost along the same lines. Like you can optimize for short-term growth and short-term who are the users today, or you can optimize for what the actual users of the technology will be in a few years, or I mean, who knows how long, like the actual institutional usage, which means optimizing for different things. And that may be compliance and like that may be different conditions on who's allowed to move tokens. That may be supporting private chains and permission implementations of ledgers that are very different than how can we support the 47th L2 launched on Ethereum yesterday and then the 48th launched tomorrow. Like, is that super important or is that more of like a nice to have to chase retail funds in the short term? I think it's just a difference in thesis and longer term thesis obviously takes longer time to play out.
Right. And if how I see it is that the real cross-chain market is people, again, like I talked about earlier, paying with their on their phone with their apps, I'm paying with my stable coin, and that may get transferred to a different chain. And so if you're like the back end that's facilitating this, or just traditional institutions doing trading, exchanging, which is massive volumes, that those assets are being settled on the back end through something like CCIP, that's like real volume. And if that becomes widely adopted, I would assume the DeFi market will just use that same standard, because that's where all the money is. And then where all the money is, that's where the liquidity is. That's just how you get access to all these other assets that you want access to. So I just think winning that market will probably win you the DeFi market.
Yeah, and it's hard for me to see any other, like I just don't see any other bridge working with institutions, or at least not building the solutions that they actually care about. It's almost like they're building in a vacuum of like they think they're building for this giant wave of users, and then eventually when the users don't have these financial incentives anymore, they start to gravitate and move on. It's just a symptom of the broader financialization of our ecosystem. Um, is there anything else you want to hit up on, like how you see tokenized assets evolving? Like, is it just stable coins you see taking off? Is there a specific asset class? I know Sergey talks about like the longer tail of financial assets. Like, is it going to be the tokenization of every fund, more BlackRock funds? Like, curious what you see is like the tangible thing, or is it just going to be like art paintings and gold?
I mean, I don't think I'm enough of an expert to say exactly what assets will be tokenized. I just think that whatever comes first, like it's just a superior form for an asset, a medium for an asset, or a superior digital form for an asset. And so obviously the ones I see talked about are funds, tokenized funds, where your shares in the fund are tokenized, and then those can be traded around, carbon credits, or whatever, any type of like unique asset that doesn't have a lot of market infrastructure for it yet. I see people talk about that. Um, yeah, I think for anything that you might want to fractionalize, maybe like a real estate or very large assets that you can fractionalize, so people don't have to buy the whole asset. That's probably another appealing benefit of tokenization. Um, but and then as more assets become tokenized, you need more payments to be tokenized, so you can facilitate easier, DVP type buying and selling between them. And then I think it's just like a snowball that starts rolling downhill. Then more assets go into that farm, and eventually you have it's a standard for all assets that all basically all exist along the same infrastructure, which brings with it its benefits of efficiency and other things. So like I said, I'm not an expert. I don't know if anyone knows exactly what, if people have opinions, but I don't think anyone really knows. We're just waiting to see what really starts to take off first.
Yeah, I mean, it's kind of the same thing as the internet in the early mid 90s, where nobody really knew what the end state use case would be, but they know that like there is a tangible use case that exists here. So I wish that the US wouldn't be so hostile in the meanwhile towards what's being built. It seems like unless something significantly changes, most of tokenization is going to happen in other regions of the world, Asia, Middle East. It seems like that's specifically a high level of interest for those governments there. But I don't know. I'm cautiously optimistic. I'm curious if you see anything moving in the US anytime soon.
I mean, I consider a lot of what they're doing as like posturing. So they might not actually it's like negotiation. You go hard, you lowball someone in the beginning, but your end goal is you're not going to get that amount, you're not going to get everything you want. So I feel like a lot of what's going on is simply posturing to try to get to a point. Like they know they're not going to get everything, but they're kind of like, going hard to then release a little bit. And also you get the benefit of like kind of looking like a good guy. So I feel like a lot of it's just posturing going on. They want control. They want their control on the industry, whatever that form that takes. And so, it's just about, kind of, it's like a negotiation going on. I see how long that takes. I don't know. Is more as other countries like adopt and maybe gain usage, it puts more pressure on it. I don't I don't see an Ethereum ETF lasting years. I think it will come next year. Honestly, I just think there's too much money in the space. There's too much. I mean, look at all the money that BlackRock and them got from people, buying Bitcoin ETF. I just think there's too much money there. Uh, Tokenization benefits the existing system as well, so it's not like it's something that's like we're taking it down. So I think I just seen too many negotiations where it looks like it's all lost, it's going nowhere. They're just completely against it. Like I don't. To me, it's just a bargaining tactic to. It's actually it could be closer than people think.
I mean, if it's a negotiation, it's like a hostage negotiation a little bit because they're the ones who define the game for us. But yeah, I mean, I, I mean, I'm not a lawyer, so I don't know how things will shape out exactly, but it does seem like a lot of the activity is they haven't banned crypto, but they basically made it impossible to operate any kind of crypto business in the US, and they obviously don't want crypto businesses at this stage operating in the US. I'm optimistic that that'll have to change over time, otherwise the US will just fall behind other nations, and that will actually become a national security issue, ironically, if that happens.
But like I said, they're just trying to get the the crypto players to loosen their stance or trying to gain leverage on them or hold them out longer. So to me, it's just a kind of a negotiation tactic. They're trying to pressure them, hold them out, force them to cave a little. And so eventually though, I think the BlackRocks and the other will put pressure on the SEC to to get a Ethereum ETF, get some because there's some regulations in place. Like there's too much money to be made, and if margins to be got by banks, improvements in their margins. So I think it's just a matter of time. I don't think it's going to be years, but I don't think it's going to be the next few months either.
Yeah, to kind of, I think to wrap up this podcast, if if you're somebody who like you believe in the long-term tech of crypto, you believe in tokenized assets, and you think that that's the way the financial sector is going to move, is eventually fully on-chain and verifiable and in some manner or format that it shapes up, like, but you're burnt in the short term just based on the market conditions and the you see the crypto casino mania and just the degeneracy that happens. Like, what would you tell somebody who's kind of feeling burnt out almost in these market conditions? Like you know what the end state's going to be, don't know when, and you just see all this mayhem. That's honestly a little demoralizing at times. Like, what would you say to them?
Find a hobby like outside of crypto. I mean, yeah, if you think it's you just take some time away, find a hobby, do something else, like constantly focusing on the industry through its ups and downs can be depressing. Um, or focus on things you can control. So, whether if you're working in the industry, just focus on continuing to build. Like if you really believe the value prop of what you're building and you believe this is the end state, then this is the perfect time to just put your head down, build, continue to, you know, try to work with partners and capital market players or DeFi players that are really doing things. And if you're not working in the industry and you're just, going crypto, just, I after people have been through these cycles, you just got to check out a little bit. You got to take a little break. You got to go find a hobby to take your mind off it. I find that's you know the only way to get through kind of the lull periods or the down periods. Because we might be in a lull period for the next several months, if not even toward the end of the year. I would not be surprised if that's kind of the case. So, don't don't let it consume your whole life, because if you're waiting, "Oh, I can't wait until I make it," like you gotta take your mind off and find something else to do.
Yeah, basically don't overthink things. I think when people like zoom in so closely on crypto, they track every single small like day-to-day movement and like you just get so lost into the weeds and like if you're just a passive like participant enthusiast, then I think either like yeah, you start building something within the industry or you don't need to focus on it every single day. Otherwise, you'll absolutely burn your mental sanity over time. There's way too many distractions that are going on, and I think people don't realize that, like in terms of normies, like just regular people, they haven't thought about crypto since FTX. Like really, like every time crypto comes up, it's like it, it doesn't have a good reputation. Basically, AI took the light for like innovative tech thing that's happening currently, and people just don't really think about crypto currently. So realistically, retail capital won't step in until some macro liquidity changes or institutions actually step in a big way. And until either one of those things happen, it's not really worth stressing. Like either those things are going to happen or like I don't think the industry is going to die at this point. So it's really just more of a when versus an if. And like stressing about is it going to happen tomorrow, next month, next year, the year after shouldn't really realistically make a difference. But it's hard to say when you have a lot of money on the line.
Yeah, but you gotta just accept this is the current reality. If you try to like fight against it and you want it, so it's like anything in life. You want it too bad, it's bad. Like you're gripping it too tight. You need to just kind of accept it, and you know, it'll make the time pass a lot easier, and you also make better decisions once you accept the current reality that exists.
And I found it's a lot easier if you have a very clear thesis of like what you buy into, like what you're focused on. So you have some conviction, so you can actually step away and you don't have to actually pay attention to it. And you can revisit and see, okay, was this thesis completely invalidated? Like, is this protocol no longer being used or being developed? Or is there any interest? And but if you like if your thesis hasn't been invalidated, then it just needs more time cooking. Like it's not worth like just stressing and changing your thesis every 2 seconds because the market didn't react perfectly to every single uh, launch or every single thing that's happened in the short term. That's a good way to just absolutely stress yourself out unnecessarily. But yeah, this was I think it was a good discussion. I think we touched a lot of different topics actually from tokenized assets and all the different market dynamics. Hopefully we have another podcast sooner than 8 months from now when market conditions are completely different. But it was good talking to you, Crypto Oracle, and thanks everybody for listening.